Andrew, talk to us. Basically, your data is showing that if you work for a value-based company, you're actually quite into buying your own stock at the moment versus a growth company.
That's right. So the research started because we were observing more broadly that the actual disparity in performance of value versus growth companies is bigger than it even was in the tech bubble 20 years ago. And so we want to see, well, is there some fundamental reason why that might be the case? And we looked at a couple of things, but the very interesting one that you talked about was what's the buying behavior of these managers like if you compare buying at value companies versus buying at growth companies.
So how much conviction does this give you that we're not in a value trap, or being that when you have value stock that just get cheaper and cheaper and cheaper?
We took a lot of conviction from this and from other metrics that are listed in the report as well. You know, these people inside the company, the senior management, they will be the people with the best view. If those companies were struggling, even if it hasn't come through in the performance, you'd expect them to have the best view. So the fact that actually the relative levels of buying of the value companies versus the growth ones, the management, the levels were at all-time highs. Relative appetite for the value companies gave us a huge amount of conviction that this is just a big mispricing at the moment.
So, I mean, but when you talk to value investors, particularly some of the ones that have been kind of flummoxed by the past few years where value kind of fell out of favor, I mean, they always make very compelling cases as to why value, why it works or why it should work. But the timing always seems to be off. And I'm wondering, when you're using these models and you're looking at this data, is there a timing element that sort of gets factored into it or that you can apply to it that would maybe make it a little bit easier for folks to figure out how to? Go ahead.
Sure. No, well, one of the points we make in the paper is that actually it's very difficult to time anything, frankly, in the market, particularly to time value. If you miss the first 12 months of the rally, for example, that's all the benefits. In the long run, value outperforms. But if you've missed that turn, then you've missed all of the benefit. And so actually, the message is you can't really time it, but what I think you can do is lean into it. So what we try and do in our portfolios, for example, is as value gets cheaper, we tilt more and more to value, and as it gets expensive relative growth, we come away from it. And so in that way, you're actually leaning into the cycle rather than fighting it.
Yeah.
So I'm lucky enough to get a handheld mic here. But I want to ask, if you have those saying, okay, you should not be timing this is a long-term structural change that we may be seeing, what do you say to those who argue then that we are just seeing head fakes, that value is dead? Because some people out there do make that claim.
Well, the most dangerous argument in investment management is this time it's different. You have lost a fortune over the years following that siren call. And so I would say, yeah, maybe, but almost always it isn't different. And believing it is costs you a lot of money in the long run. So we feel very confident, as I say, that you've got this huge under the radar disparate performance from value versus growth, but there is no trap there. Actually, the fundamentals are very sound.
Andrew, there's been much debate about, what is momentum now, what is growth, what is value. Does what a value company is resolutely stay the same? How do your models change with it, update, or do they remain?
Well, no, we're always looking and adding new factors. So we talk about value as though it's a single thing, but actually we have 5 separate signals typically in our models of different elements of value, and so we sort of composite that when we talk about value as a factor. So we're always looking for different ways of expressing it, but value by and large has been pretty consistent at its heart over the last 20 or 30 years.
How would you respond to the folks who also say that growth has been pretty consistent and that there's no reason to sort of get off the growth and momentum stocks at this moment?
Well, as we talk about in the paper, if you look at the relative pricing performance, the relative sort of cheapness of value, we're more than 90% in its history. It's past the 90th percentile. Every time we've seen that in the past, we've only seen it twice, once in the tech bubble and once at the trough of the financial crisis. And each time it was followed by an enormous rally for value that more than eclipsed the losses. And so I would say history is not on your side.
We've had it a little bit already. We have had some buying of the Russell 2000, the small caps. We were just having Lizanne Saunders on from Charles Schwab, who was saying, look, if you look underneath, she thought it was quants mainly that drove this desire to get into the rotation of late, because she says actually if you look at the fundamentals, she doesn't really care if the valuation is really compelling for a small cap. A lot of them are zombies, for example. Do you think some of the buying, why do you think the buying petered out thus far that we have seen of into the value?
Well, I don't think you can ever tell when a bubble, what the catalyst is going to be for when a bubble is going to pop and when it's going to change in the long run. You know, when we look back through the prism of history, it's often easier to write the narrative, but at the time it could be some incredibly small thing that nobody really notices. So I don't take too much significance to the fact we had 2 strong days and then some flatter days. But what it did show you is how sharp those moves can be when they start to move.